today I kind of want to give you guys first like a journey of what I've been through, and maybe Andrew will agree. I would love to get his input from his experience because he's worked with many investors over the years, and help you understand how investors really fund deals, right? Because I think there is a lot of misconception, especially for new people enter the investor world. They are shocked. I remember talking, I talk to new investors, often, and like I had no idea that there was even institutional money. I had no idea that I could buy a flip with no money out of pocket. I had like it blows their mind, right? And that's was the same for me when I got started, right? I didn't know this until like someone taught me this and then made the connections like, hey, here's a hard money lender. Hey, here's a maybe private lender. Hey, here's how you do DSCR loan. Hey, buy like it's all just networking, right? So I'm excited to kind of share on that a little bit. And then in the trainings or sessions that we're going to continue with in the 2026, I'm going to go deeper into each segment, I guess, of each niche of the loans. But like I said, Andrew Shanti, he's a big reason why I am here, right? He's a senior vice president. He's my mentor, who I bother every single day when I have challenges and questions, because it is a very dynamic business. I can tell you that much. There's constant changes in lending, just like there's constant almost changes in real estate. Well, actually, there's more changes in lending than there is in us being agents. Let's put it that way. That's a fact. Like the amount of changes that happen in just underwriting with different capital partners, in-house direct lending, it's unbelievable. I feel like there's a new thing every month that's being released that we have to stay on top of. So that's point number one. That is very interesting and intriguing to me, that you have to be on it. If you want to be a good resource for your investor clients, you really have to be in it full time, almost to understand and treat your clients correctly, because things change fast. And then, interestingly enough, today we had our team meeting, and this is thanks to AI. Andrew, AI gave me a snippet of what we talked
So
about.
I was wondering how you grabbed that, Randy. Yeah, I saw that right before we started. I was like, man, it's a nice little addition right there. Yeah.
This was literally from today's meeting. We had our wrap-up meeting with all the loan officers, which I don't even know how many loan officers we have, Andrew. How many loan officers are Optimists now? Is it like 30, 40, or
I'd say there's probably 30, and that's about increased by almost 20. So
about to?
it's
Yep.
about to go from 30 to almost 50. Yeah.
Amazing. And look at these numbers, guys. The year-end performance review highlighted the team's significant achievements. Record 681 loans closed in 2025, an increase from 499 in 2024. That's 312 million. So I'm showing this not to, because yes, that's important to me. I don't know if that's as important to you, but to me, that's important. I wanted to partner with somebody that had a lot of experience, right? That, they're not learning the business, right? Nothing against it, right? We all start somewhere. I needed someone behind me that was a machine already, that had the connections, that had the wholesale connections, the private lender connections already built, because I already have the audience that I need to help, right? I didn't have time to wait and work with the company starting out. So this was very attractive to me, on top of course, the positive reviews. Uh, with that said, I want to jump in. So Andrew, I'm going to kind of be, I want to make it conversational. I know enough to be dangerous, but I'm going to look to you for some of the answers and make it a conversation out of this, right? The first thing I realized quickly when I was before opening up the lending division powered by Optimus, I always referenced private money, that it's an individual person lending you money, and I referenced hard money, institutional money, but I never called institutional money private money. But I've recently learned, right, when I joined Optimus, that actually private money lending to investor involves wealthy individuals or private entities lending their own capital directly to other investors. So really, private money is also hard money. And I think a lot of the education out there doesn't necessarily connect those dots this way. And I think they kind of separate: private money is an individual person, hard money is an institutional. And I think it could be confusing to some of you when people are marketing themselves private money, only then to find out it's institutional money, or maybe it's a company that's renting directly, like in this case, private entities. So I wanted to make sure you know that, number one, because that being in a business for so long, I've never seen it that way. And it confused me when I seen a hard money lender advertise that they're private money. I was like, that doesn't make sense. Well, now this makes sense. They're private entities, like Andrew. We're like a hybrid, right? We like to
We
call
are,
us
yeah.
a hybrid company. We have access to capital partners that are private entities that in most cases you cannot even go to as a consumer. And then we also have a direct lending arm. And I know you have a beautiful way of explaining this, Andrew. What's your definition of us, I guess?
Yeah, so great question, Randy. As far as the way that we're structured, we are a true hybrid correspondent lender on the wholesale side of the industry, which is a very fascinating place to be. So, as Randy mentioned, we have our own in-house capital, which allows us to move very quickly and very efficiently on deals that we like on your fix and flip, your bridge, and your ground up construction, which is all your short-term debt. And then on the long-term side, we're backed by the five largest sources of private real estate investment capital in the country, which is where it gets into this institutional concept of hard money, right? And so, with that being said, that institutional money basically consists of pension funds, hedge funds, life insurance, and health insurance, companies that provide to the tune of sometimes, a billion or 2 billion or $3 billion a year into the world of real estate investors, right? And there's a very specific reason to this. So the whole driver of our industry behind everything is the need to place institutional capital and get a yield on the money. Yield is just a rate of return on the money. And so investment grade real estate is a very interesting place to put um, this institutional capital because it's measurable, it's definable, right? So what makes a investment property investment grade is that it's underwritten for performance based off of the asset as opposed to necessarily the borrower, right? So if you've got just someone who's buying a house to live in, those loans, which are done by conventional mortgage brokers, are basically underwritten based off of the borrower's job history. Did they have any gaps in their job history? What's their credit? The borrower's ability to pay the mortgage. Whereas on the investment side of the industry, which is all we do, we only work with real estate investors. And we cover the full scope of investment lending. So fix and flip, ground up construction, every type of rental and commercial real estate. It all really falls under the umbrella of hard money, right? Because it's either private individuals lending money or these large private institutions like your pension funds, your hedge funds, your life insurance companies, your health insurance companies that are underwriting to a criteria that has shown them over time that it's going to perform. So the whole basis of our industry is that the asset is going to pay the mortgage as opposed to the individual, which
Yeah.
is a very interesting concept. And then when you back that out as to like what happens in the back end of it, these large pools of mortgages are basically pooled together and sold, typically in $100 million to $200 million allocations called a syndication. And that syndication block basically funds a portion of large pension funds that are then able to get a 6%, 7%, 8% yield over, call it a 3 year or a 5 year period of time. So the whole driver really of our industry is pension funds being able to block off a good portion of money and make sure that their pensioners are going to receive that income that they need to keep the pension liquid. And so that's where the institutional money comes into place. And over really the last 10 years, the industry as a whole has really transformed itself because 10 years ago, a lot of the institutional players weren't there. It really was more so private money. And as the industry has developed and grown, I would say on just a 1 to 4 unit residential investment properties, there's probably about $20 billion a year in loans that are run through our industry. And that is serviced, I'd say, by maybe 1,000 to 1,500 people. So it's a very niche industry, like that just works exclusively in this sector. Conventional mortgage brokers can do these loans, but they're not experts in the space. Whereas we're niche operators that really understand this. We only work with real estate investors. We live, breathe, and sleep this, so we understand the dynamics of what actually happens on these properties. So that's kind of the difference. You have these private operators, which, as you said, is the private money. Your uncle, your friend, your relative, your business partner, someone you met at a conference. There's the concept of a gator lender, right? That's your private guys that are lending their own money, and then you have the institutions, and we're really bridging the gap between all of them so that we can service our clients both in a private capacity and in an institutional capacity to make sure that they have the best ability possible to actually close their deals. And as you said, Randy, it gives just this phenomenal breadth of options available to people, regardless of what their situation is. And when there isn't a solution for them, we have the knowledge and the awareness of how to guide them to get to the place where they're fundable.
Yeah. That was the biggest thing for me. That was like an aha moment. So bottom line, what I want to use for today's presentation is let's categorize this for the reference of what we're going to talk about. Private individual money is exactly what it says. It's that private entity money. We can also call it hard money, but that's the language I would like to use. When I say private individual money, then that's what we're talking about. Single people, like individual people that you might know, a friend, a doctor, a neighbor, right?
Uncle
Versus
Joe.
private entity money, AKA hard money. Okay. So that's how I want to make sure we set the tone. And I want to also speak more in general terms, right? Of course, it's good for you to learn about Optimus. That's awesome. And I also want you to really kind of look at it from a perspective like, okay, what should I discuss and ask the lender that I'm currently work with, right? Maybe you're not, maybe they didn't tell you certain things, or maybe you're going to have things you're going to learn today that you can go to them and ask them more deeper questions, right? That's the goal of this, right? This isn't just talking about Optimus necessarily, even though I'm excited about it. And I did wanted to announce it to everybody that I am now part of Optimus and I have a lending division. But I want to really make it more general. If you are interested in learning more and working with us, I will just put the link in the chat and you can do that there. But here's what I've learned being an investor for many years. So some of you might not know, from 2010 to 2017, I lived in San Diego and I built one of the largest flipping businesses in San Diego fairly quick with my partners. Under the company CT Homes. We did about 350 flips. And this is really how our journey started, right? 1 to 5 deals, we were borrowing private entity money, which was hard money, right? For majority of purchase and all of the rehab, right? And that's to the tune of 90% of purchase. Back then, honestly, 80% was kind of the going percentage, right? Now, 90% of purchase is very common. Back then, and this is 2010, 2011, 12, 13, I did not see a product offering 90% back then. So we were borrowing 80% of purchase, all of the money on the rehab in most cases, or we would then borrow private money for the gap, the closing costs, and sometimes the rehab, if we just wanted to borrow hard money for the purchase, right? So when the first 1 to 5 deals, usually not only myself, but usually for all newer investors, that's where they kind of operate in. They don't have cash sitting in their bank account that they are able to deploy to buy properties, right? And even if they did, that cash would go dry up really quick if they bought 5 houses, for example, right? So you always getting into the business, you want to have access to money. And it could be hard money or it could be private individual money, but you need access to money because eventually most of us are not sitting on millions of dollars in our bank account that they can just deploy to their flipping business, right? As far as the people I know, they're starting the way I'm describing. Then when you get and graduate to the 5 to 10 deals per year, and this is kind of per year, you borrow private individual money for pretty much all of it in most cases. Like we started building such good relationships with people because now we're having a track record. So as you start building a track record, it's a lot easier to ask for money, right? And show them the opportunity of returns, right? So most investors start getting more comfortable because now they have experience, they have a track record. They have case studies. It's easier to raise private money. And a lot of times when you do one deal with somebody and they get a nice return of 8, 10, 12%, they want to deploy more money. And then next thing you know, they're funding all your deals, right? And that's good when you're in that 5 to 10 range per year. It works amazingly. When you start graduating to about 10, 20 deals per year, you start mixing up private entity money and private individual money again, because you're almost outgrowing your private money resources in a lot of cases, right? So you start mixing in hard money again in most cases, because now you're like, oh crap, I got 20 deals going at the same time, right? I can't find enough private investors, right? Good problem, but that's how you start basically, continue to keep bringing in resources for your funding. And then when you start going past 20 deals a year and beyond, really, is when you can start approaching and have a track record of about 2 years or so, at minimum, probably 2, 3 years. You can actually go to banks. So that's what we did. We actually build a line of credit with a local bank, right? So one first step, we moved all our banking to the local bank for our whole investing business. So all of the money was flowing through there. Then, because we had a track record, they started with a line of credit for $250,000. Then that line of credit went to $500,000. Then it went to $1 million. Then it went to 1.5. I think we were at $2 million line of credit at one point. And then what we ended up using is a little bit of the capital from the line of credit from the bank, and the rest was private individual money. We completely stopped using hard money at that point, right? So our cost of money went down quite a bit, because across the board, our cost of money was around 8 to 9% with no points, right? Which is amazing, right? But that's not where most investors start. If you have private money on your first deal, amazing, congratulations, but I'm telling you, that's usually not the case. So with this kind of beginning journey of a roadmap, Andrew, let's maybe dive into a little bit of a private money product that's out there, right? And like I said, for when I say private money, I'm talking about in hard money, private entity money, hard money, right? So now it's very typical. We get 90% of purchase, right, and 100% of rehab. That's pretty typical. But what are some of the parameters that the institutional investors kind of put into place, right, to tell you how much they're actually going to lend you? Because they can get you in the door by just the marketing tactic by saying 90, 100, but is it always?
No, it's not. And so experience matters a lot, Randy. And also it doesn't, which is kind of a curious thing, right? So experience in our industry typically gets you better rates, but you can get full leverage in some instances in some markets, even up to 100% of the purchase price and 100% of the rehab cost, even for a first-time investor out the door, which is kind of wild that
Yeah.
there's hard money out there that will do this for first-time investors, so long as they have the credit and the liquidity and a good deal, right? So really it comes down to what qualifies a good deal, and really what qualifies a good deal is it going to be exitable, right? So the the quick money side, when it comes to like a bridge fix and flip product, is designed for speed, right? So we have the ability to close a loan in as quickly as the same day, right? So I'll give you an example. I had a client that called me at 8 o'clock in the morning. It was the business partner of a real estate investor that I had done a deal a year before. They had a really good experience with us. And he gave me a call at 8 o'clock in the morning, and I basically shoved my entire day on the floor, and I got him docs out by 8 o'clock that night. It was $1 million deal in Boca Raton, Florida, that had a $1.7 million after repair value on it. The guy had experience, the guy had liquidity. It was a bankruptcy foreclosure auction with the trustee sale in 3 days. There was no time left. He had title insurance done, and he had title and insurance done, no appraisal, but the comps were there, right? Like, so in a very tight bracket, we found 6 properties that placed the value of this property at 1.7 million. There's no question that the property was worth 1.7 million dollars. So because the numbers were there and there was no question it was going to be a profitable deal, it just made sense, right? So from the standpoint of the money, we're always asking, is this something that's actually going to be pulled off? And is there profit on the other side? And so when it comes to profitability, the number that we're looking at on, say, a fix and flip deal is the after repair value. So you have the as is property value. We want to make sure that people aren't paying more for a property than what it's actually worth. And we want to see that there's going to be a value in them doing the renovations to it, that they're going to have a spread by the time that they're done. So there's got to be a profit center on the back end of it, whether that's to exit as a refinance, if they're going to keep it, i.e., via the BRRRR strategy, or if they're just going to sell it and make their spread and kind of keep going on to their next flip. So, what we're looking at typically is up to 75% of the after repair value. So, we'll do 90% of the purchase price a lot of the times, 100% of the rehab cost, and that is as reimbursement draws, right? So, this is really important to understand. You have to have money available to begin your rehab process. You have to have money available to pay for your closing costs. You can use gap money to cover your other down payment a lot of the times, right? But you do have to have liquidity to begin the actual process of construction, and you have to have the money to pay for your closing costs on the deal. So it's not a get in free type of situation. And you also have to have enough money to make sure that you can cover the mortgage payments for at least a few months while you're building the property out and getting to the finish line on it, right? So you have to have some skin in the game to be able to make sure that it's going to be successful. And that's really what we're underwriting to. So we're looking at, does the property make sense from what they're buying it for? And does it make sense from what it's going to be worth when it's done? And
Yep.
that's kind of the basic framework is it going to be profitable to the investor? And does the investor have the wherewithal to pull it off? Right. So if you're dealing with a first time investor and they're coming to you with a real estate transaction that say has $400,000 in rehab and they've never done a project before, the deal's not going to get done. It's just going to be way too much risk for the average real estate investor to pull off a $400,000 rehab when they've never done any project, unless they have a lot of money, right? That's kind of, if they're sitting on $800,000 in liquidity, $1 million in liquidity, and they're doing a $400,000 rehab. Yeah, they've got enough money to weather problems that come up in real estate, right? So one of the problems that you see for first time investors is trying to tackle too much too soon. Would you agree with that, Randy?
Oh yeah, they definitely try to take on more than they can chew. And that's one of the things I talk a lot about when I see deals come across my desk is first I check the ARV. A lot of times the ARV is off to begin with. Then the second
Mm-hmm.
thing that's off is the construction budget, right? And that's kind of common, right? Because a lot of investors starting out, they try to make deals out of no deals. And this is very common for me. I always tell them, look, the best deal you're going to do is the one I'm going to tell you not to do. So don't feel bad because you're not going to do this deal unless you go back to the drawing board and get a reduction. If you could get this reduction of 20, 30K, great. You have a slam dunk. Let's go. Right. So I agree. There's a lot of that happening. And what's sad is that sometimes the lenders that are out there, they don't take that approach, right? If they can squeeze in the loan and get it through, they'll push it through because they're making the commission. They're not thinking about a long-term reputation aspect, right? And I don't want to
Absolutely.
do that. I don't want to be pushing loans through just to push loans through. I want to build a long-term relationship with every client I work with. So if I have to decline a loan because I don't agree with their numbers, I'm going to decline the loan. And they might not like me, but I know deep in, I'm going to sleep at night because I told them, don't buy this deal because you're going to lose money, right? If they choose to, that's their prerogative. So one of the things that I also learned right away is that they're looking at the 75% of ARV, right, as the gutter, the boundaries, right? But then also loan to cost is something that a lot of the hard money lenders or private entity companies that lend are also implementing, right? And total loan to cost, when they say, when you see that number, and usually you'll see something like 85 loan to cost or 90% loan to cost. Can you explain that, Andrew, and how that can kind of impact what?
Absolutely. So you've got two different things when you kind of enter the lending world and different lenders out there that approach the market the same way. And this is a really great question, Randy. So there is loan to after repair value, right? Which is where the maximum loan amount is based off that 75% of the final valuation, right? So if you've got a $200,000 after repair value on a property, our maximum loan amount is going to be 75% of that. So our maximum loan amount would be 150,000, which could be based off of 90% of the purchase price and 100% of the rehab up to that 150,000. 150,000 is 75% of 200,000 after repair value. Basic math, it's very easy. So the other metric and how some of the lenders operate in the market is what's called loan to cost for what Randy said. And loan to cost is a different formula, which requires you to have more skin in the game, right? So loan to cost is the purchase price of the property plus the rehab. And if you're dealing with a ground up construction, it would be the purchase price of the land plus the construction budget for the construction aspect of it times, say, 0.75 or zero point 0.8 or 0.85. And those numbers, 0.75, 0.8, 0.85, really go into experience, right? So it becomes very much more experience driven to get to a higher loan to cost. So when you have a loan to cost formula, you're usually going to have more skin in the game in this particular case, because if you're at 75 loan to cost, you have to have 25% equity in the deal. If you have 80% loan to cost, you have to have 20% equity in the deal. If you're at 85 loan to cost, you have to have 15% equity in the deal. So on a loan to cost formula, you're going to have to come to the table with more money down, and you're not probably going to see that 90-100 unless there's kind of a really strong balance. Well, you're not going to see 90-100 period at 85 loan to cost, right? You're going to see typically we're always going to do 100% of the rehab cost, and then whatever's left will go towards the purchase price.
Yeah. What I've noticed is that it's been common that when a lender has the 75% ARV, which it's almost everybody for flips, but then they layer on top of it a 90% loan to cost, what really the purchase percentage becomes is actually around 86, 87% that they will
Oftentimes,
actually end up lending you. So even though it's being advertised as a 90-100 program, you actually don't get 90. They're not lying. They're saying, hey, we'll do it if you fit these two parameters, which are very hard to hit. 75% ARV with 90% loan to cost layered on top of it. It's almost very difficult to hit. So I want to just kind of give you that, ask those questions when you're speaking to lenders, like, hey, do you have a loan to cost basis as well? Because then that will impact the 90-100 program. Like I said, I'm going to go deeper into every one of these future sessions, but I kind of want to just give you some important snippets of what to think about on the beginning as you go through this journey and speak with different lenders. And I know many of you work with investors too, so you can even help them ask those questions because they might not even know. So what we're really talking about is active income. And somebody asked us in the chat just now, well, you're creating active income through flipping, right? It's no different than a realtor selling houses gets commission. So private money, individual cost, usually when I was borrowing it and when I still borrow it, it's going to land somewhere between 8 to 12%, depending how bad I need the money and how much of it I have available, right? And if it's a small amount, if I'm only borrowing, let's say 50,000 from a private individual, that's not a lot of interest, even at 12%, that they would receive if I'm turning that product, the house, in 4 months. So what I like to do for a private individual investor, and usually on slow loan amounts, I would guarantee them 6 months of interest to entice them to give me that money for the gap, right? So that's kind of a rule of thumb to remember. If you're borrowing money from private individuals, you might not get them excited about 8% or 10% on 50 or 100,000 if you're going to tell them you might hold on to it for 3 months and they're going to be in second position. So now they're taking on more risk and they're not really going to make a lot of money. So how do you entice them? Well, guarantee them X amount of months. So in this case, maybe you say 6 months guaranteed interest of 10%. Now that has worked a lot better. So that's private individual money. I rarely paid points with private individuals. I've done it in the past. If I was in a crunch and maybe my first lender fell through. So I have done it, not that I haven't, but typically I don't pay points to private individuals. When you're talking about private entity money, aka hard money, you're going to be somewhere between as low as 9% for pro investors that have experience to about average 12. It will always range somewhere in there between 9 and 12. And you're going to, you pay from as little as 1 point to as many as 4 or 5 points if you're asking for a hard money loan for 100,000, right? So it will depend on how big is the loan amount, of course, as well, and your experience, right? But for
And
your
also the risk of the deal.
and
So
the
if
risk of the
you
deal, yep,
so if you're coming in with very low credit and which makes you a much more riskier client, it's going to mean that you're going to pay a lot more in
right,
points, fees, and interest because the risk is higher.
that's
You're
right.
you're 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 a bad risk borrower. You're a high risk borrower. So you may end up with higher fees and higher points on a deal because the capital that's willing to work with you is just very much a more expensive capital that's willing to work with credit challenged borrowers.
That's right. So usually leverage will go down. When we say leverage, that means that instead of the 90, 100 program that they advertise that you called someone off, they might say, well, we're going to do 70, 100, right? So now you have to find 30% of your own money just for the down payment, plus closing costs, plus the monthly costs, right? And the money to start the rehab. And like Andrew mentioned, yes, you can borrow gap money, which is what we did when we were starting out. However, also ask your lender if they allow secondary financing. A lot of them do not allow it. That's number one. Some will allow it. And what I also found, the ones that do allow it, they will actually make you pay interest on the full loan amount, which includes the rehab money that they're holding in an escrow account for you to spend, right? To draw from. So that's called Dutch interest. They're going to actually charge you out of the gate, right? Day one, interest on the full loan amount, the purchase amount and the rehab amount that they have set aside for you for the draw. Where if you're not borrowing secondary financing, usually you will not be paying interest on that rehab money until you actually draw it, right? So those are some nuances that if you don't ask those questions, and then next thing you know, last minute before closing, you're like, oh, by the way, I have a private money guy sending 100,000 for the closing, and then that's when the institutional lender finds out. They'll be like, oh, okay, well then your monthly payment now just doubled, and you're like, wait a minute, I wasn't prepared for that. Well, you didn't ask those questions, right? So ask that question because many times it's a no. Now, how do you get around it potentially in a ethical way? You can still borrow money from people, right? You can borrow money. There's no law against you borrowing money from people as an individual. You just can't record a lien against that property because that's really what they're saying when they tell you we don't allow secondary financing. They don't allow it against that property that they're lending to you on. So you can't record the lien. Now, can you have a promissory note with a private investor that wants to lend you money for your business activities? That's between you and the private person, right? So that's how others have done it. So I'm not going to go any deeper because we could, I want to cover the
Hey,
next
hey,
thing.
Randy, I want to make a quick comment on what you just mentioned with the promissory note. So this is something that's very important for you guys to be aware of. So when it comes to working with promissory notes, Anything under 9 months is not considered a security. Once you go over 9 months on a promissory note, it becomes a security transaction and you're subject to security law. This is really important. So if you are going to borrow private money with a promissory note, make sure that that promissory note is under 9 months, because if something goes wrong with the note after that 9 month period and ends up in the court of law, you can be charged with securities fraud, or you can be charged with unlicensed securities activity, which can come with some very heavy penalties. Most people
And what
don't
if you
realize
do?
this. Yeah.
So what if you don't have a promissory note for 8 months and then you need an extension and it goes past 9 months? Do you automatically trigger that potential?
You renegotiate a new promissory note, Randy. So you want to make sure that you don't go over 9 months on the promissory note, because then it does become a security. Which,
Okay, got it.
if something goes bad, it's look, it's when things go bad that you have to worry about it. So you want to make sure that if you're going to go over 9 months in borrowing private money, specifically with a promissory note, guys, right? There's other structures that you can utilize, right? So as an LLC, you can have up to 100 members in your LLC, and then you don't need to use a promissory note. Then you're just basically giving away a portion of the company and a portion of the profits as part of the operating agreement within a corporate structure. There's no promissory note to that. That's just a private in-house agreement between the members of an LLC, right? So just be aware, if you're specifically working with promissory note greater than 9 months,
Good.
it becomes a security. You're supposed to register it with the as a security filing, and the SEC will get involved and charge you with securities fraud or unlicensed securities activity if it goes into the courts in the legal realm. Just be very
Okay,
aware of
perfect.
that.
Glad that's why you're here, Andrew. You're keeping me out of trouble. So what I heard at the end is just rewrite the promissory note, right? So
You
it's a
got it.
brand new note and it doesn't go over 9 months. Thank you. So let me
You got
jump
it.
into the next phase, right? So the roadmap of an investor. So you're building active income. You're doing 1 to 5 deals maybe the first year. Then you're doing 10 to 20 deals maybe second, third year. Now you're doing 20 plus deals. One of the things that most of those investors will end up doing is they'll end up keeping a couple of those deals as rentals. That's just smart business, right? This is how you start building wealth, right? So and this is also one of my current regrets. I wish I bought more when I was flipping so many houses and kept them, meaning uh, I didn't keep enough. Let's put it that way. Okay. But that's the typical journey, right? They start keeping some of them and then what they call it the BRRRR method, right? Where they buy it, they rehab it, right? They rent it and they refinance it. Sometimes you can refinance it even before you rent it, right? Not a problem. But most of you probably heard of the BRRRR method. And that's where the DSCR loans became very popular over the last few years, right? Especially in the boom, right before 2020. Uh, and what that stands for is debt service coverage ratio. And they have loans for DSCR loans for long-term rental type tenant, midterm, or short-term now, okay? Where we can literally use the short-term rental income to get you approved for the DSCR loan, right? Which is really the debt service coverage ratio. And again, without getting into the weeds today, what you need to know is that the coverage needs to be, we like to see it at 1.0, and I'm going to let Andrew explain exactly how it's calculated in simple terms. Go ahead, Andrew.
Sure. So the main metric that we're underwriting to when it comes to a rental property is, as Randy mentioned, DSCR, which stands for debt service coverage ratio. And what that means is, does the income coming in off of the property cover the mortgage, tax, insurance, and HOA, right? And so if you have a rent in place with a tenant that's, say, $1,500 a month, when you look at the mortgage payment, the tax, the insurance, and the HOA payment, you're allowed what's called 1.0 debt service to get to the highest leverage. That's break even. In other words, you've got $1,500 a month coming in on the rent payment, and you've got a $1,500 a month mortgage payment, mortgage, tax, insurance, and HOA payment. That is the underlying metric of a DSCR loan, period. And that's how we underwrite to the highest leverage, whether that's 85% on a purchase, 80% on a purchase, 75 on a cash out. And then there is, some flexibility in kind of how we get to those higher numbers. but the whole driver of our industry is that 1.0 debt service. We always want to see that 1.0 debt service because that means that a deal is it's at least breaking even. It's not going to be costing the investor money every month. The income coming in covers the mortgage expense, which is again the way our entire industry is underwritten towards.
Now,
Now,
do
if you
they
have
take
a go ahead, Randy. Yeah.
do they take into account vacancy rate or anything, or they just literally just take what you said, right? Mortgage payment, taxes, insurance, and HOA, and maybe property management fee? Is there anything else they take into account?
So when you're buying a property, what we're typically looking for is we're looking for 6 months interest reserves to cover the vacancy factor, Andy. So we want to make sure that when you're buying a property, that you have the liquidity that you could cover the mortgage yourself for at least 6 months. That
Got it.
covers the gap, and so you get a tenant in place, and then that tenant is then taking over the mortgage payment essentially, or paying your mortgage for you.
Okay, so the DSCR calculation doesn't take into account vacancy rates and anything like that.
No, it doesn't.
Okay, perfect.
If you're moving into a commercial product, then and by commercial, I'm referring to 5 unit plus as commercial as opposed to like a duplex, triplex, quadplex. That all falls under the auspices of like single family residence, 1 to 4 unit, non-commercial. When you move into a 5 unit plus scenario, then you have a vacancy factor that's typically applied of 5%.
Perfect. Hey, Chris, you have a question. Go ahead.
Do you guys do DSCR loans where on purchase where it's not like, let's say it's vacant?
Yes.
You can do those. Okay.
But it has to be rent ready. Like I just had one investor send me a property that needed, I can see mold, I can see all kinds of stuff.
Right.
No,
It can't
that
have
has to
living
be,
condition. It can't have living condition issues, right? Basically.
yeah, it's got
Correct.
to be
Yeah.
livable. Like, does it
Livable.
have to be fully renovated? No, but we just, like just got to be there. Like someone can actually live there, right?
Got it.
The basic
Okay.
premise is somebody could walk into the door and live there. So if you've got a broken window, the broken window has to be fixed before they close on the property, right? And that's something else to be aware of. So if you're and I have seen this happen with investors where they're getting ready to buy a property, but there's a few things wrong with the property. And so the weekend before they actually go close on it, they'll go in pre-closing with a GC or with a handyman, and they'll fix the window. They'll put liquid glass on it. They'll replace like a siding board. They'll tear up the old carpet and put down new carpet before they actually close on the property, such that it is in rent ready condition by the time that they close. And the seller in those situations may include a seller's concession or a closing cost credit to cover the fact that there was $5,000 worth of work which the investor had to do prior to closing, and they'll take that out of their sale proceeds.
Yeah. And just, in general terms, just also be aware that yes, you can get loans, DSCR loans. And just maybe say this, we don't ask for tax returns. Any lender does the DSCR loan, we're not asking for your income, right? It's all based on the income of that asset, and that income could be projected income or current income. Now, there are certain scenarios where, they might require it to be rented with certain unique situations, but in most cases, you can buy a property when it's not rented and they go off the market rent analysis when the appraisal is done, right? And that also includes short-term rental, right? That you can actually buy a property of projected short-term rental income, but they're not going to use 100% of it. In most cases, they're going to use 75% of the projected short-term rental income, and usually they pull that off a website called AirDNA, right? So just know that most cases they're not going to use 100% of your short-term income to qualify you for the DSCR loan to hit at least that 1.0 that Andrew was talking about, right? Because that's the sweet spot. The 1.0 in most cases will give you the most leverage and best pricing. The pricing gets better, which makes sense if the DSCR goes higher. If you have a DSCR of 1.20, now in most cases your interest rate will be cheaper, right? So there's things like that that play into pricing and terms of DSCR loans. Another thing I want to mention is that, if you have an established short-term rental that has a 12 months of history, those we have capital partners that actually will go of 100% of that for the calculation of DSCR. So there's all kinds of nuances with DSCR loans that we don't have the time to break up today. I'm going to do a separate session on it, but I wanted just to give you the gist of what to expect. You can leverage up to 85% of purchase on DSCR loans, and you can go up to 80% and cash out DSCR loans, where you actually walk away with money. Maybe you have the property free and clear, or you're refinancing a smaller loan and you want to, cash out additional money, right? Those can go up to 80%. One thing that can also play a role, and this is important when you're talking to lenders, make sure you tell them when you bought the property out of the gate and ask them if they have seasoning issues, right? Some lenders have seasoning issues, so they might quote you something, but they don't ask you the right question. And then later, like, oh, wait a minute, you bought that 2 months ago? Ooh, sorry, I can't do the loan because we need to wait 6 months before I can give you the loan, right? So some will have a 6-month seasoning issue stipulation. Some will have 3 months, and some will have 0, right? Where you can literally buy it today with a flip loan or with cash and refinance it next week with a DSCR loan based on actual value of the property. So you can buy a property because you got a smoking deal, you help somebody out of a rough situation, whatever the case might be. You bought it for 200 and it was worth 300 as is. The next day you can go and apply for a DSCR loan and it will be based of 300. Not with every lender though, right? So you got to ask those questions, right? Seasoning is very important. And then also, what value are they going to look at, right? Are they going to look at the actual value, or are they going to take into account what you just paid for a week ago, right? Chris always has questions.
Randy, what is your seasoning requirement for DSCRs?
No seasoning requirement.
Well, we have all
There's
types. We have 0, we have 3, depending on who we go with.
That's good.
Right?
Okay.
So yeah, we have all types access to it. So that's DSCR.
And I
that's another referral source I can send you, because the lenders I work with have a lot of the ones that I do DSCRs with, they all are 6 months.
6 is standard in the industry. So if you were to make 100 phone calls to 100 lenders in the industry, you're going to hear 6 from most of them. 3 is kind of needle in a haystack. The no seasoning is, you're talking to us, basically, is kind of where that's coming from. So those are relationship deals that don't even necessarily exist on the retail side. So those are basically a wholesale channel with wholesale operators that only work with groups like ourselves and don't even necessarily have a retail division. So they don't work front face with the public. They only work with aggregators or wholesale accounts like ourselves, which we're one of the largest wholesale accounts in the country for a lot of the investors that are behind us.
And I would say
That's
same
really
thing
awesome.
goes, Chris, I would say probably, and Andrew, same goes for prepayment penalties. The standard in the industry is a 5-year prepayment at 5% every year, or a step down, 5, 4, 3, 2, 1, right?
The ones I see are like 1, 2, and 3 years is what I usually can offer most of my lenders.
Yeah, we have options to go with 0 prepayment penalty, right?
That's awesome.
That's rare, right? Where you have no prepayment penalty. Now you're going to pay
The interest rate's higher though, right?
Interest rate is going to be higher, of course, because they're in the business like everybody else for you to keep that low, right? They don't want you to sell it and get rid of it. But in a situation like I just did for one of our investors here in Florida, he bought a property, couldn't sell it, right? The market here in Florida is a little rough, couldn't sell it. So he had to lower his overhead. We refinanced him out of a hard money loan, right? We were able to use midterm rental to qualify him for the DSCR to be above 1, so we can get him better pricing, right? We paid off the hard money loan, lowered his expense, and he wanted the flexibility of selling that property maybe in 2026 if the market improved. Guess what? The market is improving, rates are dropping, right? So that was a good thought to kind of think ahead. So what was important to him is not to have a 5-year prepayment penalty where he's going to be dinged 5 points, right? This was a $600,000 loan. That's 30 grand, right? So what did he want? As low as possible. So with that particular product, we were able to get him 6 months of a prepayment penalty because that was enough to get him to the beginning of this year, right? So now, after 6 months, which I think is going to run out in like March, he's got flexibility to sell the property and not pay any points of prepayment penalty. Again, very rare in the industry. You're going to hear mostly that, there is prepayment, you can't get around it. But again, this is why I wanted to join with Optimus, because we have so many different options depending on the goals of the investor, right? That's always my question. Like, what is your goal? If you're going to hold on to this long term, you might as well do the 5-year, step down, because you're going to get the best pricing. Like, don't worry about the prepayment penalty. But if you're telling me you might want to try to sell it in a year or two, well, then you might want to pay a little extra in interest so you have that flexibility and not pay 5 points or 4 points or 3 points, whatever it is, right?
A lock in the interest.
All right, last slide, because we are over time, but I want to cover this because this is where Andrew, has the most experience. I haven't done really these loans, but I want to finish on it. So as the investor goes through this journey, like I mentioned, right, we start doing the active income, we start flipping, then we start keeping some of them, right? Some of these investors, including us, we were like, let's develop a house. Let's build a house maybe. So then we start kind of, usually on like a year 4, year 3, year 4, we start getting comfortable. We have enough of our systems in place where we're like, you know what, we can handle a new build, right? And then we start doing it one new build at a time, right? And just see what that's like, see what, just build systems around it, really. That's what it comes down to, because we have the flipping system going. So 1 to 2 new construction projects, single family homes, right? Those you're going to do new construction loans from private entity money, and new construction community development. So that's like subdivisions. That's kind of that next step. So after most investors maybe will do 1 or 2 new construction or 3, they might consider doing small subdivisions, right? And guess where they get that money? People like us. So Andrew, can you briefly, in like 5 minutes or less, explain how new construction money operates in terms of kind of percentage and what, how do you decide what's good?
Yeah. So when it comes to new construction, experience, right? And specifically when we're looking at experience, we want to see ground up construction experience. So unless you have experience doing very heavy rehabs, we can count those as ground up construction experience, but you're starting at the bottom, right? So if you're coming in as a first time ground up construction individual, you're going to be at 75% loan to cost. So you're going to have 25% skin in the game. The way that most people operate with ground up construction is they go buy the land, they get their plans, and usually in cash, they get their plans and permits in place. And then once they have their plans and permits in place, they come to us for the vertical financing. And then we're going to look at the purchase price of the land plus the construction cost, multiply that times 0.75, and that's going to be our maximum loan amount. Hopefully, we're able to fund 100% of the construction costs based on that formula. If not, you're going to have to kind of, again, we may be funding 90% of the construction costs, in which case you're spending, $10,000 and we're reimbursing back, say, $9,000, right? Just depending on how much money is left, base of that 75% loan to cost. As you get into like your 3rd and 4th deal on ground up construction, and by the way, experience is what have you done in the last 3 years, right? Very specifically, it's what have you purchased in the last 3 and exited in the last 2. That's the standard definition in our industry. So if you built homes 10 years ago, you're starting from the beginning, right? But you're going to start at that 75% loan to cost. Once you get some experience, you may move up to 80% loan to cost. Once you're kind of in the pro borrower status, you can get up to that 85 to 90% loan to cost on these deals. They're going to be 12 months interest only, no prepayment penalty. Most ground up construction deals are going to take you anywhere from 9 months to a year to build. It is one of the riskier products in our industry because the hold time on a ground up construction is longer, so the exposure to the market is longer. So it's going to be a slightly different underwriting process. Ground up construction deals are going to require a full appraisal, whereas a fix and flip deal is usually a desktop appraisal. it's always going to be a full appraisal and a ground up construction because of the risk factor of the deal, right? Ground up construction is going to take you typically about 30 days, maybe 45 days to kind of get to the finish line compared to your average fix and flip or bridge loan, which we quote 21 days, but they usually close in 7 to 10 once we get all of our docs that we need, right? So just be aware, ground up construction is going to take you longer. We want to see plans and permit in place. We do not take approval risk, right? So you or entitlement risk. So if the project's not approved, we're not interested, right? So you've got to have your approvals in place, and you've got to be ready to go by the time you show up for us to get your money. You guys, you will not find money for land anywhere in the industry, right? So just be aware that land is not financeable because it doesn't make any money. It's just a straight cost. And when you look at the bad debt on all of the books of the banks out there, it's two asset classes. It's land and it's office buildings, right? That is the bad debt that's out there. And because that's the bad debt, nobody's lending on land. Even really good land is next to impossible to get a loan on. So land is basically done in cash. And then once you have plans and permits in place and an approved project, that's where we step in. We try to give you 100% of the money for the construction costs. And if there's any money left over, we may be able to give you a little bit of money against what you paid for the land, but it's usually not the case. You're usually, out of pocket, all cash on land.
Perfect. Yeah, hence why, most investors don't do new construction out of the gate, right? Same thing was for us. We started dabbling in it, I think on year 3. Why? Because we had some cash set aside that we can buy the land, apply for the permits, get everything ready, and then we can finance the rest, like Andrew said, with institutional money. So that's the typical journey. That's how, investors scale their business. It doesn't happen overnight. You have to kind of build it up and use a combination of institutional money, aka, like I said, we also call it private entity money. This is why you might see private on our website, right? Or you use private individual money, right? Rarely do I see new investors start out of the gate and get all private individual money. Very rare, right? So now it would be amazing, and that's my goal, if we can help you scale to the point where you have so much leverage, so much experience, and you start getting private individuals throwing money at you. God, awesome. You'll probably still be referring me business because I helped you get there, right? That's my goal, right? I want to see you succeed. I want to see you get private individual money because that's the cheaper money. I want you to go and get a bank line when your business is ready for it, right? That doesn't mean we stop doing business, because you're going to have other needs. Guess what? You're going to need DSCR loans. You're going to need new construction zones, because that means you're growing also with your business. So our relationship as a lender won't end just because you start learning how to raise private individual money, period, right? I'll be cheering for you, right? So again, like I said, we went over time, but appreciate everybody still sticking here. We're going to put the recording on YouTube, on all the social media things, and I will be going deeper into each topic on future trainings because there's not enough time. There's so much to cover on each individual loan product. It's crazy and wild, the things that I've been learning. So Andrew, I want to thank you for your time, for joining us
Thanks
here.
for having me, Randy. And Randy, we're great having you part of the team. It's been really great getting to know you, and what a great asset you are.
Thank you, buddy. Thanks. I'll be calling you probably in an hour with a loan question.
Thanks.